So I'm always careful to say, like, if everything were that good, like that we talked about this, if your alarm bells of this is too good to be true aren't going off, then you probably need to calibrate those. It sounds too good to be true. So when people ask, well, what's the catch? What am I missing? Why doesn't everybody use these? I think of it not so much as a catch, but more like limitations. It's not limitless. The first limitation on these is that you have to be 62 or older to qualify, and that kind of makes sense. No financial institution is going to give a 30-year-old $300,000 line of credit, let them max it out, and never make a payment, possibly till they die if they stay in that home. That's just not something. You can't even imagine a financial tool that could figure out how to make that work. So I don't know why they chose 62 instead of 63 or 61, but it's very obvious why they didn't choose 30. So these are available if you're 62 and older. And there are some products that require you to be 55 instead, but for the FHA insured product, it's 62. Another limitation is that these are relatively low LTVs or loan to value loans. We call that a principal limit factor in the reverse mortgage space because it isn't actually a loan to value because it's a line of credit, not a loan. It's a little different. But essentially, if you think about a traditional loan, we often think of regular mortgages or forward mortgages as something like 20% down, 80% loan. I mean, there are 90% loans, there are 97% loans, there's even 100% loans for VAs. But reverse mortgages are nothing like that. They're in the 30 to 60% range, depending on your age. So they're lower. So the first two items here, that this is usually the biggest filter that disqualifies people if they want to get one. This is usually the reason that they can't. Either they're not old enough or they don't have enough equity. So the very first filters are you got to be old enough and you have to have a decent amount of equity. The next one is you can only do this on your primary residence. You can use the money, like the proceeds from the reverse mortgage, you can do whatever you want with those. But you can only put the reverse mortgage on your primary residence. The next limitation is there's a limit that FHA puts in called the HECM limit. This essentially is how much real estate they are willing to lend against. What this means is if your house is worth $600,000, then let's say your credit limit would be, let's say in this example, it would be $200,000. Well, if your house is worth $1.2 million, your credit limit would be $400,000. It would be double that because the real estate is more valuable. But if your house is worth, $2.4 million, your line of credit won't be double that again, because this is where FHA steps in and says, hey, we're willing to do this, but we're only willing to lend against $1.2 million worth of real estate. So again, your house could be worth 1.5 and they would give you the loan, but they would limit the calculations, do the calculations as if your home was worth 1.2 million. That's another one of the limitations that we can get around by using some of those non-FHA loans. They will do massive millions of dollars worth of real estate and millions of dollars worth of lines of credit, but they have other pros and cons that make the FHA one still significantly more popular. The next limitation is that there's a cost to it. This is the book that I wrote about this with my brother. He's a CPA. We call this the financial ugly duckling. It's something, I love that metaphor. I wish I'd come up with it, but I got to give him credit. He was the one that thought of that idea. But when people see something that looks kind of familiar, right? Oh, it has webbed feet and a beak, and it's sitting there with another duck, and I'm familiar with ducks. That must be some kind of sick duck. But the truth is, it's a different animal altogether, and this is one of the ways in which that becomes clear. When sometimes people are tempted to look at this like a mortgage, but more expensive. And it is true that it is more expensive, but it also is not a traditional mortgage. It's something very different than that. And the way I think of this is, if you want to include the equity in your home in the financial planning process, if you want to access the equity, there's 3 ways you can do that. The first one is you can sell the house. And in certain circumstances, that's exactly what someone should do. If they need to downsize, if they're not in the right home for themselves, or if they need to move closer to family, there's nothing wrong with doing that. But if you sell the house, you have to downsize or rent. Otherwise, you're not really accessing any equity. You're just putting it into the next home. And that may not be desirable for people. And also, it's a very expensive way to access equity. Selling a house is not an inexpensive way to get money. It's probably the most expensive way to get money because selling houses is an expensive process. The next scenario, or the next way you can do that, is you can get a traditional loan or a HELOC. And again, there are circumstances where that's exactly what someone should do. And I work for a mortgage company. It doesn't matter to me which product they use. We can help with any of them. And there's scenarios where that makes sense. But you have to remember that's going to require a monthly payment. And in a lot of cases, it might be hard to qualify for a mortgage that requires a payment while I'm in retirement and not earning income. The other option is a reverse mortgage, and there's a cost to that. And the reason there's a cost to that, the advantage of the reverse is that you get to stay where you are, so you don't have to move if you don't want to, and there's no required monthly payment, among the other things that we talked about. But if you think about that cost, again, that's 2% of the value of the home. So if it's a $500,000 home, that's a $10,000 premium. It's only paid once. So you pay it when you get the mortgage in the first place, but that goes into that insurance pool that ensures that all of these features stay intact. And if you think about that for financial people, that just clicks. That makes sense because if you're going to ask a financial institution to go into a financial product with a client with these terms, right? Payments aren't required. The balance could be outstanding for decades. The credit limit grows for the life of the loan, and all of that is non-recourse. A financial institution would never go into a loan product with those terms because they recognize that, well, someone could borrow out the money, never make a payment, live till they're 110 years old, and I would have to eat hundreds of thousands of dollars worth of loss. I'm not doing that. And that's
Right.
where FHA comes in and says, we'll take care of that. We recognize that that can happen sometimes. We'll create an insurance pool. We will guarantee and insure it so that when that happens occasionally, because it can happen and it will happen occasionally, FHA comes in and makes that whole. If you think about it, it's more reasonable to say that this product wouldn't even make sense without that insurance. The other considerations that I'd point out is that these lines of credit get enormous. And remember that the risk to the financial institution that this mortgage insurance covers is at the end of the timeline, not in the beginning. It's a little different than traditional mortgages. But if you think about how big these lines of credit get, in this example, we talked about $1 million home when they were in their 60s. And let's say now it's worth 1.5 million, but they've got a line of credit for $1.8 million. These are massive lines of credit. So when you compare it to another loan and say, well, this is like another loan, but it costs more, when you think about how big these lines of credit get in the future and how much protection is required to make sure that that's non-recourse, all of a sudden the cost of the insurance policy starts to make a lot more sense. Because when claims are made on that pool, they're big because we're talking real estate. They're hundreds of thousands of dollars big. So those are the limitations that people need to understand and kind of how these work so that this financial product or just like any other financial tool, whether you're talking about a loan or annuity or a life insurance policy or an ETF or a mutual fund, they all have to make sense on two sides of the equation. It has to be attractive to the client, but it also has to be sustainable and workable on the financial side. Otherwise, it wouldn't be available. So this is how they make that stuff work. This is how they appease the too good to be true instinct. This is how that works. Just high level, a good metric to run by is just thinking about who is a reverse mortgage not good for. And I think of it in terms of anybody who can make their home equity liquid, if they can qualify, should do that because that's just a good thing. But there are scenarios where this doesn't make sense. If you're expecting to leave the home soon, there's no sense in paying the cost of getting a reverse mortgage in place on the home only to walk away from that home and sell it a year later. There's probably a better financial tool. If they need money, there's probably a better solution than a reverse mortgage. So if somebody has a short time horizon in that home and and they know they're going to be selling it, this is probably not a good solution for them. Another one, this really isn't, this one's kind of hard to describe, but I think about people who, if I'm concerned that they might blow the money, I certainly couldn't say, hey, you can't have access to your wealth because I think you might spend it irresponsibly. That isn't my role. That's their money and it's their wealth, so I wouldn't keep them from it. But sometimes there are scenarios where we want to get adult family members involved because maybe we sense that somebody's coercing them to get access to this money, like a kid or a grandkid that might have an addiction problem or something like that. Or in general, what I like to do when we're helping people with these is get financial advisors involved to make sure that they understand that when you spend this money, it's the equivalent of spending your equity. And if you spend it all, it will be gone. And if you still need more money after it's gone, it won't be there. It's just like any other financial wealth that you've got. I like to say it like this. You should spend your equity as carefully as you would any other form of wealth that you have built a lifetime building, because that's exactly what it is. So it can be, especially because these have been associated with people who have run out of money because they haven't had other options. In some cases, they just haven't been disciplined with the money and they get access to hundreds of thousands of dollars and they just spend the money irresponsibly and it's gone. And then people say, oh, the reverse mortgage took their house. And it's like, well, they really just spent their equity is what happened. We would never say that about if somebody spent their IRA irresponsible. We'd never say, oh, the IRA took all of their wealth. That isn't really reasonable. But we tend to say that about reverse mortgages, and what really happened was they spent their equity, and of course when it's gone, it's gone. So we want to make sure that people understand this in a larger context, in an overall financial plan, and use it responsibly, because it is a large amount of wealth that belongs to them and they've spent a lifetime building. They need to be careful with it. Now that we've talked